I don't think this is going to ruin your holidays after the recent election. I think we're going to find out that this may not have any impact whatsoever on your holidays. But in light of that, and in light of what Dan just spoke about, I'm going to be speaking about, again, closely held family business transactions and 2704, which is a code section under the Internal Revenue Code that's been around for a long, long time. But over the summer, there was, the IRS issued proposed regulations that would change how this code section is implemented. So as a background to the code section, because I'm sure a lot of people in this room have no idea what it is or what it does, and it's very simple if you think about it simply. And then I'm going to make it complicated, but I'm going to start out simple. Traditionally, when someone gives away an interest in a closely held business, we have been able to discount the value of that interest for purposes of gift and estate tax, because when you give away a closely held business interest to a third party, they have the inability to control that business if they own a minority interest in that entity, and they have the inability to freely trade or sell that business because there's no free market. It's not it's not traded on any stock exchange. So as a result, we've been able to discount the value of the gifted interest. Now, why is that important? It's important because we're only given so much exemption from estate taxes. Currently, the federal exemption is $5,450,000. I have that right, I think. And if we're giving away an interest in a business and we want to preserve as much exemption as possible, we would love to be able to give away that asset at a discounted value. So, for example, let's say I have a $5 million piece of property and I've put it in an LLC, and I want to give away a 20% interest in that LLC to my daughter. Now, when I give her the 20% interest, she is getting an asset that does not give her control over the entity. I still have control, and she's given an asset that she can't freely sell. Typically, when we have that interest valued by an appraiser, they would come back and say, for purposes of, because this is a closely held business, the discount's going to be somewhere between 30 and 50%. I mean, it has been as high as 50%. So even though the underlying asset value of what I just gave my daughter is $1 million, if we have a 50% discount because she can't do anything with that asset, it's kind of useless in her hands, then we end up with a gift of only $500,000. Which saves us $500,000 in estate tax exemption that can be used in the future. Now, if you've got an estate with a 40% tax and you've saved $500,000 in estate tax, you saved what? $200,000? $200,000 in tax. So that's like a meaningful number, and that number, is incrementally larger as we do larger gifts. So that's just sort of a background so you understand why we care about this. Because this is a technique that we use all the time in estate planning. We wrap things in business wrappers so that we can give them away and use that lack of marketability and lack of control discount. So the IRS years ago passed Congress passed Section 2704, and the IRS said what they thought it meant. What it means is they are trying to place restrictions on intra-family transfers of family-controlled entities so that we disregard the lack of control and lack of marketability discounts, just simply stated. So they want to make sure that those get valued at their full net asset value as opposed to the reduced value. And they do that by saying that we ignore any lapsing, voting, or liquidation rights and any restrictions on liquidation. And I'll explain what those are in a moment. How does it work? Okay. Section 2704 has two prongs. The first one is that they say, okay, if you have an asset and you give it away, and the person who receives it can't liquidate the entity, and they have no right to vote for any management decisions in the entity, that's what reduces the value of that transfer, because they can't do either of those things. And 2704 says we're not going to take that into account in an intra-family transfer. Okay, if you have a lapsing, voting, or liquidation right, we're going to ignore that, and we're going to value it at its full amount. The second prong is 2704B, and it says, if you have a restriction that limits the ability of the entity to liquidate, which lapses or can be removed by the family after the transfer, we're going to ignore it. If you give it away, then, and you require that you have unanimous control, that person who receives that business interest has no ability to liquidate the interest. But if the family can take that out of the operating agreement by amendment and say, okay, we don't want that anymore, all of a sudden everybody in the entity might have the ability to liquidate. And without that, because they can eliminate it, they will not permit them to use that as a restriction that affects the valuation. But they will allow that if the restriction is not more restrictive than the restrictions imposed by federal or state law. So if you set up your LLC in a state that has restrictions on liquidation that are perhaps unanimous vote of the members in an LLC, then you can use that in your operating agreement, and that will apply. You will be able to use that to reduce the value of the interest that's transferred. Because of these rules, we have a couple of strategies that we've been able to use to not circumvent, because that's not really true, but work our way through the current rules where we can still discount even under the current rules. And these are that many people designed their operating agreements so that they give, when an interest is transferred to a third party, what that third party receives is called an assignee interest. And an assignee interest typically is an interest that has no voting powers and has no right to liquidate. This is the same thing that happens under state law if you don't have anything in your operating agreement that says what happens. So because the transfer of an assignee interest is not more restrictive than state law, we've been able to rely on that in order to circumvent 2704 and still get our discount. Another thing we've been doing is we've been making transfers of inter vivos transfers of minority interest. Because if I give away only 20% of my business, that vote's not going to have a lot of impact in a majority vote LLC, and it's also not going to be able to liquidate the LLC. So the argument there has been that there is no giving up the right to liquidate or to vote in that case, because that's just inherently the way a minority interest is treated. They're not giving it up, they just never had it in the first place. The other way that we've gotten around it is to set up our LLCs, as I said, in a jurisdiction like Virginia, for instance, or even Delaware, but Virginia is even better, where you have to have unanimous vote by statute of the members in order to liquidate the entity. If you've got that, then you've really got some very good case law and on your side for taking a discount. And then finally, some people, and I've never done this myself, but some people decided that it was okay to transfer nominal interest to non-family members so that the family alone can't be able to remove any restrictions on liquidation after the transfer has occurred. And they believe that you get around 2704B with the non-family members. Well, the Treasury does not like any of these very legitimate currently, but also a little bit outside what the intention of the statute was. They don't like them. So 2704 regulations, the proposed regulations, are designed to get rid of all of these planning techniques. So that's basically how they've closed the door. And what does the new proposed regulations apply to? Because that's the first thing you got to figure out before you even think about 2704 and whether you care, because you may not care in a lot of instances. So what does it cover? It covers corporations, partnerships, LLCs, which was added in the new proposed regulations just to make it clear. It also might cover any jointly owned real estate that's being operated as a business, because if it's being operated as a business, it may be treated as a business despite how it might be treated for federal estate tax purposes or income tax purposes. It has to be also a controlled entity, an entity that's controlled by the family. In this case, it does involve family attribution rules. So if an individual, the individual's estate, and members of the individual's family own, directly or indirectly, and I'll explain that in a second, at least 50% of the capital and profits of the entity, or can liquidate it, then it's considered family controlled. Now, what's interesting about that is that would also include ownership directly or indirectly of sub-entities. So if you have a holding company and sub-entities that may have different owners, you got to look through all of these things to figure out if they have at least 50% ownership. You have to look through trusts. If they're beneficiaries of trusts, then they may have 50% ownership that's sort of indirectly owned. And what is also interesting is that they define control as at least 50%. So what that means is if I have family A owning 50% of the business and family B owning 50% of the business, they're both controlled by both those families, in spite of the fact that neither party can actually control them. So how did they eliminate the, I'm going to call them loopholes, but I'm going to get in trouble for saying that, but what we've been using to get around 2704. What they said was, we're just going to get rid of assignee interest discounts. Those are transfers that result in a restriction of any rights and powers associated with the transfer's interest. You no longer have voting powers. You no longer have liquidation powers. This was meant to be covered by 2704A, and we think it should be, and that's how we're going to interpret the statute going forward. So that was just eliminated. Minority interest discounts, giving away small bits of the company during your lifetime. They couldn't get rid of that because that argument's legit. If you give it away and the person who receives it, nothing happens to that interest. They just simply don't have enough of it to be able to exercise control. They recognize that. But what they did say is, we'll recognize that, but we're not going to recognize it in terms of deathbed transfers. If you know you're going to die, like your 95-year-old who transferred to the trust, then you, within 3 years, or are likely to, and you do, then we're going to bring that back into your estate, and that discount's going to go away for purposes of that. So that one's not completely gone, but it's definitely been reduced. This one's really crazy. They've basically said that they don't care about state law anymore. They're saying, we're trumping state law. If the state law has a restriction on the ability to liquidate the entity or lapses that can be removed by the family member after the transfer, and if this restriction, such as a unanimous voting requirement, like Virginia, unless this restriction is required to be in the documents or is in the documents, like either the operating agreement is running afoul of the law because it's not in there, or it should be in there, it has to be mandatory before they're going to accept it as something that will reduce the value of the gift. So unanimous voting powers are only going to be accepted if it is mandatory under the state or federal law that applies. So that's a big change, because before you could kind of choose to apply it or not. And they said even if it is mandatory, they're going to ignore it if the law was, because some of the states have really helped out the taxpayer by putting in these restrictions to circumvent 2704. So they're saying, okay, states, we're going to slap you down for trying to get around this, and we are going to put in some exceptions to this rule, which say that if the state law is limited to certain classes of entities, such as family-controlled entities, we'll disregard that law, and that's not considered mandatory, and we will still consider it something that to which 2704 applies. And they also provided that if there's any type of alternative to that mandatory restriction, then you have to take that into account in valuation. So if you just make a choice as an attorney or a business owner to set something up in one way versus another possible way of doing it under state law, they're going to disregard the more limiting way that you set it up, if you could have done it in a way that would have not produced a discount or reduced the discount. So that puts a heavy burden on the estate planning attorney and all you guys to figure out where do you do these things and what could possibly screw us up if we take a discount. We have to look at all the laws that apply to creating and transferring these entities in those jurisdictions. One of the other things I mentioned was the use of giving little nominal interest to non-family members. Well, they kind of closed the gap with that by putting in place this thing called disregarded restrictions. It's a brand new concept. And what they said is they are going to ignore certain restrictions just entirely if the restriction lapses after the transfer or the family members can remove the restriction. And those restrictions are limits on the ability of the interest holder to liquidate their interest, limits any restriction that limits liquidation proceeds to less than minimum value, Minimum value is, if you're familiar with valuations of businesses, there's a concept that begins as freely traded value or net asset value, which is what the business is worth less deductions. So if you have debts and things associated with the business, so it's value of the underlying assets less deductions in a business, for instance, that owns real estate and operates commercial real estate. But they've said the only deductions they will permit to reduce the value of the assets are those that can be taken on a federal estate tax return if this was an estate. So that's basically expenses, claims against the entity, and debts. So it restricts the number of deductions you can take. If you defer payment of the liquidation proceeds for more than 6 months, they're going to disregard that. Or if they permit payment of liquidation proceeds in other than cash or property, so like with a promissory note. So essentially they're saying anything that you put in this agreement that's going to sort of discourage liquidation or say to someone, if you liquidate, we're going to punish you in some way, we're disregarding that restriction. So that's what the purpose of these restrictions are. And that only, of course, happens in the case of a family-controlled entity, so if you have at least 50% ownership by the family. Now, if you have non-family members, that used to matter, or at least some people thought that mattered. But they have actually really cut into the benefits of having non-family members owning the entity as well for purposes of the disregarded restrictions. And they said that any interests owned by non-family members are going to be disregarded for purposes of determining if you have 50% ownership and the disregarded restrictions. If the non-family member has owned its interest for less than 3 years, the non-family member owns less than 10% of the entity. So if one guy owns 7%, he's completely disregarded for the 50% test. If there are two or more non-family members who own less than 20%. So if not all of your non-family members own less than 20%, you're going to disregard all those. And then finally, if the non-family member does not have the right to exchange their interest for minimal value on 6 months' notice. So basically another restriction on their ability to get out of the entity, they will disregard the non-family member's interests. And say basically the family has control over that entity. So with that as a backdrop, I'm going to turn it over to Rachel Sherman to talk about why these new proposed regulations may or may not matter to you.
So that was 2704 Regs 101, and now I'm going to talk about what all of this means in practice. So the first question is, when does all of this come into play? The proposed regs told us the effective dates of the different rules, the lapse rules and applicable restriction rules that Meg described will apply the day the proposed regs become final, and the disregarded restriction rules will apply 30 days after the proposed regs become final. But we don't really know what that means. There are hearings on the proposed regs scheduled for tomorrow. So the initial thought was, well, that means that the lapse and applicable restriction rules could go into effect as soon as December 2nd, and the disregarded restriction rules could apply 30 days after that. But we know that when the comment period closed on November 2nd, there were 9,762 comments filed with the Treasury by that date, and they all nearly unanimously opposed the regulations. So they have their work cut out for them. The Federal Administrative Procedures Act says that the Treasury must respond to all comments when finalizing regulations, not individually, lucky for them, but in categories. So Treasury officials don't think that this can all be accomplished before Obama's out of office. The White House obviously is trying to get everything done as soon as possible. So we don't know if year-end is still the deadline. It seems very unlikely. But we may still need to act fast because these are such sweeping changes to planning with family-owned assets. So if we're going to act quickly, there are some things that we need to keep in mind to avoid attack by the IRS. Two doctrines that they use to attack transactions are the step transaction doctrine and the reciprocal trust doctrine. With the step transaction doctrine, it's important that there's enough time when you're setting up a transaction to happen so that the transaction isn't collapsed. For example, if all of the money is in wife's name, but husband is going to be the one to make the gift, so assets have to be transferred from wife to husband, That might be able to be done quickly if it's marketable securities, but if you're assigning LLC interests, it may take more time. And then you need time from when it's transferred to then when the transaction happens. It can't be one day the transfer from wife to husband, next day husband funds a trust with LLC interests, or that could be collapsed by the IRS. The reciprocal trust doctrine comes up in a situation where spouses may both be doing planning and they each set up a trust where the other is a beneficiary. When that happens, and this happens with Cupert's and in other areas, we vary the terms of the trust to avoid the reciprocal trust doctrine. But another thing that we often do is have there be time between when husband signs his trust and wife signs her trust. And if we're trying to do things quickly, we may not have the 6 months to space that out. Other things to think about, and those of you out there know this more than I do, but it takes time to set up new trust accounts. And if we're trying to do things quickly, it might cause us to have to look at an existing trust for a new transaction and see if we can use something that's already there. And appraisers are obviously overwhelmed. I appreciate those appraisers who are out there and here today taking time away from working on the many appraisals I'm sure they have to get these transactions valued quickly. If the appraisals can't be done by the time the transactions are going to occur, then the transfers have to be structured using estimates or using reference to what an appraised value will be. No doubt there will be changes to traditional estate planning techniques if these proposed regs are made final. Jessie talked a lot about GRATs, and GRATs that are funded with marketable securities, like she described, are unaffected by this. So those will continue to be good estate planning techniques as long as 75-20 rates stay low. But where you have GRATs funded with family-owned assets, those will be affected by the new regulations. And when you are paying annuity payments back out of a GRAT to the grantor, ideally you're going to transfer cash back and not have to transfer business assets back to the grantor. So that will likely mean using longer GRAT terms where there's a mortality risk downside, because if you die during the GRAT term, the GRAT fails. And you need a longer period of time for cash to be generated to pay the annuity payment. So in this example, which I'm not going to go through in detail, it just illustrates how you have a 10-year GRAT where assets can be discounted, and that allows enough interest to go into the GRAT to pay back the annuity in cash. And then where you can't take a discount, how that changes things, and in-kind assets have to go back to the grantor, and then you need appraisals every year to value the business. There will also be changes to reporting and substantiating transactions on gift and estate tax returns. I know not everybody reports sale transactions on gift tax returns. We often do. And when you do that, you start the statute of limitations of an audit running, arguably, where you report the gift and then you throw in the description of the sale as well. Where people are doing pre-effective date transactions, it's probably wise to file the 2016 gift tax return as quickly as possible, not wait till April 15th, 2017, but as soon as it can be done in January, file it to start the statute of limitations for an audit running quickly. If a transaction occurs after the effective date, it's going to be important to look back at the adequate disclosure regulations, which is what starts the statute tolling if you satisfy those for the IRS. And it's going to be necessary to make sure that what you're reporting to them in terms of valuations satisfy the regulations under the new proposed regs. Different valuation rules apply for different transferees, as Meg was describing, so you may need multiple appraisals to be done, and this applies to gift tax and estate tax returns, depending on whether an asset is being transferred or distributed to family members, or is it going to a third party or charities. So in one situation, you can take discounts, and in one, you can't. Also, if an asset is split between different types of beneficiaries, you might need multiple appraisals for the same asset. So the question is Trump's win a gift, at least with regard to the proposed 2704 regs? All of the commentators predicted a Clinton win prior to November 8th. Whenever there was a presentation on this subject, and I watched and listened to many of them, everyone talked about how this was definitely happening, it was going through, and then after November 8th, there's sort of been radio silence from the commentators on how the timeframes will change and how the proposed regs themselves will be changed before they're finalized. We know that 3 bills have already been introduced in Congress that would negate finalization of the proposed regs if they pass in their current form. And we also know that after January 20th, 2017, there will be new appointees to positions that will have a say about the regulation. So even if they are finalized, will they then be changed again? So there still is a lot of uncertainty, enough so that the safest approach is still to complete the plan transfers as soon as possible, if not by year end, as soon as possible. And in speaking with colleagues and appraisers and accountants and my own clients, it does seem that most people are proceeding with transactions that they started in August or started thinking about in August when the proposed regs were first issued. One thing that's definitely certain is there is going to be a lot more to come beginning after tomorrow's public hearing. So I'm sure you will see a lot of emails and upcoming presentations from commentators once again.